Usually when we talk about a medical diagnosis, there's this comforting expectation of precision, right?
Yeah, it feels very scientific,
Yeah.
very much like engineering.
Exactly.
Yeah.
Like you break your arm, the x-ray shows that jagged white line, and the doctor just points at the screen and says, yep, there it is, broken or not broken.
Right, it's a binary reality.
But then, you step into the world of corporate financial reporting,
Mhm.
and suddenly you realize that x-ray machine is just, well, it's fundamentally flawed.
Yeah, you're looking at a diagnostic landscape that is entirely murky.
Completely murky. And today, we're going to look at a fracture that went completely undiagnosed by an entire system. I mean, a publicly traded company hid an undisclosed massive amount of liabilities, and not through some sophisticated offshore shell company scheme, but simply because their finance team literally copy-pasted an outdated Word document.
Which is just wild. I mean, it is the absolute definition of diagnostic muddy waters, and it exposes a vulnerability in the financial markets that, frankly, most investors don't even realize exists.
It really does. So welcome, everyone, to a new episode on the Gap Advisors Indeas Clinic podcast.
Thanks for joining us.
Yeah, our mission on today's deep dive is to dissect a real-world accounting error found operating out in the wild. We're going to conduct basically a forensic analysis of how a listed company completely fumbled the application of IND AS 19.
Specifically regarding employee benefits.
Right. And more specifically concerning past service costs. But before we get into the autopsy of this specific error, we need to establish the foundational framework for you, the listener, so we're all operating from the exact same baseline of reality.
Yeah, that baseline is crucial, because accounting is a language and we need to define the dialect we're speaking today.
Exactly.
So for the entirety of our discussion, the functional currency, meaning the currency of the primary economic environment in which the entity operates, and the presentation currency is the Indian rupee.
INR, right.
Right, INR.
Yeah.
And any currency that is not the functional currency is officially considered a foreign currency.
Makes sense.
Furthermore, we're operating on the standard Indian financial timeline. So the 1st of April marks the beginning of the reporting period, and the 31st of March is the end of that reporting period.
Okay, so setting the stage is vital. And speaking of setting the rules of engagement, here is our mandatory but incredibly important disclaimer.
Always got to have the disclaimer.
Always. The views expressed in this deep dive are the personal views of the author from our source material and are not binding on the audience. You should always seek the help of a qualified expert before taking any action or refraining from any action based on the views we discussed today.
Because, look, we are here to analyze, right, to dissect and educate. But every single company's specific financial architecture requires tailored professional judgment.
Absolutely. Okay, let's unpack the central premise here, because this is where the theoretical meets the practical reality of our listeners' wallets.
Right.
Why should any person investing their hard-earned money in shares of a listed company need to understand these incredibly dense, highly technical accounting standards?
It's a fair question.
I mean, if I'm evaluating a company because I believe in their product or, their market share or their leadership team, why do I need to care about the granular mechanics of IND AS 19 and employee benefits?
Well, because accounting standards are the invisible architecture that dictates the reality of the profit and loss statement you're relying on.
The rules of the game, essentially.
Exactly. They're the strict rules. So if a company uses the wrong standard or applies an outdated legacy rule, the profits you see as an investor might be a complete mirage.
Wow, a mirage.
Yeah. You might look at a balance sheet and think, wow, this company is a cash-generating machine. Their long-term liabilities are incredibly low. I should absolutely increase my position and buy more shares.
Right, because the numbers look great on paper.
But if that company is actively hiding current expenses because they misapplied a standard, that profit isn't real, it's an accounting fiction.
It's made up.
Yeah, and relying on that fiction leads to disastrous decisions on buying, holding, or selling shares.
So, if the numbers on the page are built on a faulty structural foundation, the entire valuation of the company is essentially crooked, no matter how attractive the top-line revenue looks from the street.
As an investor, you are fundamentally buying a mathematical slice of that company's future cash flows. That's what a share is.
Right.
So if their current obligations, like the money they owe their employees, are being artificially suppressed by bad accounting today, your slice of the pie is going to be significantly smaller than you anticipated when those obligations finally mature.
When the cash actually has to leave the building.
Exactly.
Okay, that brings the stakes into sharp focus.
Yeah.
Now that we understand the catastrophic financial impact of a misapplied standard, Where did this specific glaring error even originate? Because, I mean, we're not talking about a hypothetical scenario in a university textbook
I
here.
don't know, this is real. This observation comes directly from the published NAS financial statements of an actual publicly listed company. Yeah, this is a real legally binding document officially filed and published for the public, institutional investors, and retail investors to rely upon.
So we have this massive real-world error sitting in plain sight, codified in a public filing. How is this actually uncovered? Like, did the market regulator flag it during a routine inspection?
No, and that is perhaps the most alarming part of this entire scenario. The regulators did not catch it.
Wait, really?
Yeah, the external auditors didn't catch it either. The team at Gap Advisors downloaded and independently reviewed these statements on a suo moto basis.
Sumoto, meaning on their own initiative. Nobody hired them to audit this specific company.
Right, exactly. They actively, continuously monitor the landscape of corporate financial reporting. They pull published financial statements from the market and run them through their own expert diagnostic processes.
Oh, that's fascinating.
Yeah, they're essentially stress testing the documents to see how these complex standards are actually being applied or misapplied in the real world.
And this exact observation, this massive structural fumble, was then broadcast to the professional community in the Gap Advisors Task Weekly newsletter, correct?
It was, yeah. The newsletter is authored by C.A. Manish C. Iyer.
He's the director of Gap Advisors.
Yes, and it's published regularly on LinkedIn, and it basically functions as a forensic autopsy of these exact kinds of real-world application failures. He's published over 240 editions to date.
Over 240 editions dedicated to finding these deep structural errors that massive corporations are just casually putting out into the global financial ecosystem. It really highlights the scale of the problem.
It's massive.
But, what staggers me is the failure of the defense mechanisms. Think about the layers of institutional review a listed company's financials are subjected to.
Oh, there's so many layers.
Right. You have the internal finance team drafting the numbers, the chief financial officer signing off, the internal audit committee scrutinizing the policies, and finally, the independent external statutory auditors giving it their official stamp of approval.
Yeah, it's supposed to be airtight.
And yet, this fundamental error slipped through every single one of those nets and was published as undeniable fact.
It serves as a profound cautionary tale regarding institutional inertia and audit fatigue.
Audit fatigue, yeah.
When you're processing hundreds of pages of complex financial disclosures, there is a dangerous tendency to rely on what was done last year.
The whole roll forward issue.
Exactly. But this is exactly why pre-signing reviews are critical. If you are a CFO, an audit committee member, or an external auditor, getting your financial statements reviewed by Gap Advisors before you sign them and release them to the market is the ultimate insurance policy.
I can totally see how a specialized third-party review, acting purely as an independent diagnostic check, would catch the things a fatigued audit team might overlook. Because they aren't looking at the whole ocean. They are specifically hunting for these dangerous undercurrents.
That's a great way to put it. A pre-signing review isolates these exact types of legacy errors before they become a permanent, public, and potentially litigious part of a company's financial history.
And how do companies actually initiate that?
The financial statements can be submitted in a near-to-publishing PDF format via email directly to info@gapadvisors.com.
info@gapadvisors.com.
Got it. Yeah. It is a targeted expert intervention. And on the flip side, if you happen to invest in a listed company's shares, understanding that a review of a company's financial statements for strict NDS compliance has occurred, that can fundamentally help you in making a proper reality-based decision on buying, holding, or selling the shares.
Absolutely. Okay, let's shift our focus to the actual mechanics of this error. To understand how egregious this mistake is, we have to look at the specific mechanism this company was trying to manipulate.
Okay, let's get into the weeds.
Yeah, so I'm looking at the source text, and the error centers around two highly specific terms. One is defined benefit plans, and the other is past service cost.
Right.
Now, I know our audience is generally familiar with corporate finance, but let's drill into the actuarial realities of these concepts. What exactly are we dealing with here?
Okay, so a defined benefit plan is, at its foundational level, a corporate promise regarding the future.
A promise.
Yeah, it is an employer legally committing to pay a specific predetermined amount to an employee upon their retirement or, when they separate from the company.
Right. Okay.
In the Indian context, the classic ubiquitous example is gratuity. The benefit payout is defined by a strict mathematical formula. It almost always factors in the employee's final drawn salary and their total number of years of continuous service.
So the complexity isn't really in understanding the promise itself. The complexity is in the math required to account for it today,
Exactly.
because that final payout is a future obligation that's incrementally building up year by year as the employee continues to work. The company can't just wait 20 years and take a massive expense on the day the employee retires, right?
Right, they can't do that. They have to estimate that future liability and record a portion of that expense every single year the employee is employed.
Okay, so they're recognizing the expense as the service is rendered.
Precisely. The company must recognize the expense as the employee renders the service, and this requires incredibly complex actuarial evaluations.
I can imagine.
Oh, it's intense. Actuaries have to build models predicting future salary escalation rates, employee attrition probabilities, mortality rates, and the discount rates used to calculate the present value of that future obligation.
So it's basically an intricate web of assumptions trying to pin down a moving target decades into the future.
That is exactly what it is.
Okay, so that sets the baseline of how difficult just maintaining a normal defined benefit plan is. So into this already complex mathematical model, we introduce the catalyst for our company's error, past service cost.
The disruptor.
Yeah. How does this disrupt the actuarial model?
So past service cost is the financial shockwave that occurs when a company changes the rules of the defined benefit plan halfway through the game.
Ah, changing the rules.
It arises when an employer officially amends a plan, or curtails it, fundamentally changing the benefits that employees have already earned for their historical past work.
Okay, let's ground this in a concrete corporate scenario to isolate the mechanism, because I think the vesting aspect is the crux of this entire debate.
It really is.
So let's say a massive manufacturing company is facing a severe labor dispute. To prevent a catastrophic strike, the management negotiates with the union and agrees to retroactively increase the gratuity payout formula by 20%.
Okay.
But they do this for the last decade of service for all current employees. So the work was already done between 2014 and 2024. The employees already rendered the service based on the old, lower formula. But today, management signs a new agreement saying, hey, we now owe you 20% more for that past decade.
That is an excellent framework. And that retroactive 20% increase, that massive, sudden financial obligation for services rendered years ago, is the past service cost.
Boom. Sudden liability.
Exactly. The company has just created a massive new liability out of thin air through a contract amendment. The core accounting question and the source of immense historical debate is how and when does the company record that sudden, massive new liability on their profit and loss statement?
Which brings us to the ghost of previous GAAP, specifically Accounting Standard 15,
Yes.
or AS 15.
Yes, the old rules.
Right. So if I'm the CFO of that manufacturing company and I just promised my massive unionized workforce a retroactive 20% bump in their pensions, my P&L is about to take a horrific, potentially stock-crashing hit if I have to report that entire expense tomorrow.
It would be brutal.
So how did companies historically defend their balance sheets against these sudden shocks under AS 15?
Historically, standard setters recognized that fear of P&L volatility. They allowed a mechanism for what we call earnings smoothing.
Earnings smoothing, that sounds a little manipulative.
Well, let's analyze the exact wording of AS 15, paragraph 94, which the source text highlights. It basically states that in measuring its defined benefit liability, an enterprise should recognize past service cost as an expense on a straight-line basis over the average period until the benefits become vested.
Okay, let me pause there.
Hmm.
On a straight line basis over the average period until the benefits become vested.
Right.
So under the old AS-15 regime, a company could take this massive financial hit, this huge new multi-million rupee promise they just legally bound themselves to, and just chop it up into smaller, digestible pieces. They could defer the pain over several years into the future.
They could systematically amortize it, yes, but only based on the specific mechanism of vesting.
Right, let's define the parameters of vesting here, because this is where the accounting trickery really lives.
Yeah.
What makes a benefit vested versus unvested in this context?
Vesting refers to the point in time when an employee has an absolute unconditional right to receive the benefit. Right. It's guaranteed money regardless of future events. If our manufacturing company's amendment stated, you get this retroactive 20% increase immediately, no strings attached, even if you quit tomorrow, then that past service cost is fully vested immediately.
And if it's immediately vested, how did the old AS-15 handle it? Did they still get to chop it up?
No. The source text explicitly notes the exception in AS-15 to the extent that the benefits are already vested immediately following the introduction of or changes to a defined benefit plan. An enterprise should recognize past service cost immediately.
Oh, okay.
So if there are no strings attached, the expense hits the P&L today.
Okay, but here is where the corporate strategy comes in. What if the CFO says, we will give you the retroactive 20% bump for the last 10 years of work, but the new union contract stipulates you only get that extra money if you remain employed with the company for another 3 years.
Ah.
Now, that benefit is unvested, correct? Because there's a condition attached to receiving it.
That is correct. It is an unvested past service cost. And under AS-15, this is where the earnings smoothing mechanism was activated.
This is the loophole.
Basically, yeah.
Yeah.
Because the employees had to wait 3 years to vest in the new benefit, the company was allowed to take that massive, newly created liability and slice it into 3 equal chunks.
Wow.
They would recognize 1/3 of the expense in year 1, 1/3 in year 2, and 1/3 in year 3. They effectively deferred the pain of a promise they made today into future accounting periods.
I want to pause and ask why standard setters ever allowed this straight-line amortization method in the first place.
That's a good question.
Because from an investor's perspective, this looks incredibly misleading. Like if I'm looking at your P&L in year 1, it looks artificially healthy.
Right.
You legally committed to owing millions of rupees for past services, but you're only showing me a fraction of that expense. You're inflating your current reported profits by sweeping the rest of the liability under the rug of future years. Why was this ever considered an acceptable representation of reality?
It's a profound philosophical debate in the history of accounting. It's the matching principle versus fair value transparency.
Okay.
Historically, standard setters were heavily lobbied by corporations. And these corporations argued that if an unvested benefit requires 3 more years of employee service to become a reality, the cost of that benefit should be matched against the economic value the employee provides over those next 3 years.
Oh, I see the logic.
Yeah, they argued that taking a massive immediate hit to the P&L for a cash outflow that might not happen for years and might be forfeited if the employee leaves would create artificial volatility in their earnings.
Right, which would terrify investors.
Exactly, and crash stock prices unnecessarily.
So it was essentially a sanctioned illusion.
Pretty much.
It was a compromise designed to protect corporate stability and smooth out earnings trajectories, even if it meant obscuring the immediate legal reality of the obligation the company had just taken on.
It was an era of managed earnings. But the fallout from major global financial crises fundamentally changed the standard setter's philosophy.
Thank goodness for that.
Yeah. Investors, regulators, and markets realized that allowing companies to hide massive unvested liabilities off balance sheet or defer them into the future created huge systemic risk.
Yeah, it's a ticking time bomb.
When those deferred obligations finally caught up with the companies, the resulting financial collapses were devastating because the market had no idea the true extent of the leverage.
Wow.
And that ideological shift brings us out of the shadows of AS-15 and into the harsh, unyielding light of IND AS-19.
A paradigm shift.
Mm.
AS-15 is the old way, the comfortable, let's hide the bruises and smooth the earnings way.
Mm.
So what does the new reality in AS-19 demand of companies when they create a past service cost?
And AS-19 abandons the smoothing concept entirely.
Entirely.
Yes. In favor of ultimate transparency and immediate recognition, let's look at paragraph 103 of IND AS-19, which our source text zeroes in on. It mandates that an entity shall recognize past service cost as an expense at the earlier of the following dates. A, when the plan amendment or curtailment occurs, and B, when the entity recognizes related restructuring costs or termination benefits.
Just so I'm completely clear on the mechanics here.
Mm-hmm.
Under IND AS-19, the straight-line amortization is dead.
Dead.
Even if the benefits are totally unvested. Like, even if our manufacturing employees have to stay for 3 more years to see a single rupee of that retroactive bump, the company has to take the entire mathematical expense hit immediately on the exact day they sign the plan amendment.
The straight line option is entirely eliminated. The full expense must hit the profit and loss statement immediately upon the amendment of the plan.
I mean, I have to push back a little on behalf of the companies here. Isn't that unfairly brutal to the corporate P&L?
It's definitely a shock to the system.
Because if the employees have to work 3 more years to earn the vesting, and historically say 10% of them will quit before then and forfeit the money, why should the company take a 100% expense hit today for cash that won't leave the building for years if ever?
Well, because Endo AS 19 shifts the focus from when does the cash leave to when does the legal obligation arise.
Ah, okay.
The philosophy is that the commitment itself is created the very moment the promise is formalized. Whether the employee has to wait 3 years to collect it doesn't change the fact that the company has fundamentally altered its financial obligations today.
That makes a lot of sense.
And as for the employees who might quit, the complex actuarial valuations we discussed earlier, they're actually required to factor in those attrition probabilities when calculating the total liability on day one.
Oh, so the number hitting the P&L already accounts for expected forfeitures.
Exactly. So whatever that mathematically determined obligation is, it must be reported to the investors immediately.
It's basically pulling off the financial Band-Aid in one swift, agonizing motion, rather than peeling it slowly over a multi-year period.
That is the perfect analogy.
It's undoubtedly brutal for a company's short-term earnings report, but it is infinitely more valuable for the investor who demands to know the unvarnished truth about the actual weight of the company's obligations today.
Exactly. And to broaden the scope of this philosophical shift, it's vital to note for our international listeners, as highlighted in our source material, that while we are discussing this under the IND-AS framework, there is absolutely no difference between NAS and IFRS on this specific topic.
Right. IFRS being the International Financial Reporting Standards, which are utilized by over 140 jurisdictions globally.
IND-AS 19 and IAS 19 under the IFRS framework are perfectly harmonized here.
Okay.
The global consensus among standard setters is that immediate recognition of past service costs, regardless of vesting conditions, is the only acceptable method to present a true and fair view of a company's financial health.
So there's no hiding anywhere.
No. Therefore, this entire deep dive is perfectly applicable to any entity around the globe following the IFRS framework.
Good to know. So we've clearly established this massive, undeniable gulf between the two standards. AS 15 allowed you to defer and spread out the pain of unvested costs. And AS 19 forces you to absorb the entire financial shockwave on day one, stripping away the ability to manipulate earnings.
Right.
Which brings us all the way back to the listed company that sparked this suo motu investigation by Gap advisors. What exactly did this company do in their published financials?
This is where we witness what I call the copy-paste catastrophe.
Oh, no.
Yeah, our source text reveals the stark reality of their accounting policy regarding defined benefit plans. The company explicitly stated in their published notes that they are still amortizing unvested past service costs.
You're kidding.
No. The Gap advisor's analysis concludes, and I quote, "Therefore, the company has continued the policy as per previous Gap under IND-AS 2. Therefore, the company is perceived to have not complied with the requirements of IND-AS 19.
They kept doing it the old way.
Yep.
Even after the regulatory mandate transitioning them to the rigorous IND-AS framework, they just rolled forward their old AS 15 policy of spreading the cost out on a straight line basis.
They explicitly documented their noncompliance in their own accounting policies.
I am struggling to understand how this mechanically happens. Like, how does a publicly listed entity, equipped with a dedicated finance department, an audit committee, and expensive external auditors, commit such a fundamental structural error?
It's mind-boggling.
It's like a hospital upgrading to a state-of-the-art MRI machine, but still using the manual for the 1980s X-ray machine.
It really is. But it happens primarily due to institutional inertia and the sheer pressure of reporting deadlines.
Right, everyone's rushing.
Finance teams are under immense time constraints during the close of a reporting period. Often, instead of building their disclosures from the ground up under the new standard, they take their massive Word documents containing their accounting policy manuals from the previous year and simply roll them forward.
Just Control-C, Control-V.
Yeah, they update the quantitative numbers in the tables, they change the reporting dates, but they fail to conduct a granular sentence-by-sentence review of the qualitative policy wording.
They just assume the core logic remains unchanged.
Exactly. They completely miss the fact that subtle changes in standard wordings, like the deliberate removal of the straight-line amortization option for unvested benefits, completely invalidate their historical accounting methods.
It's the lethal danger of, well, we've always done it this way.
Exactly.
They technically transitioned to a new, globally aligned standard in name, but they secretly kept all their comfortable earnings-smoothing habits from the past. But as the source text bluntly states, they are perceived to have not complied with IND-AS 19.
Right.
This isn't a difference of interpretation. It's a clear objective violation of the core framework.
And a violation of this magnitude has severe systemic consequences for everyone relying on those financial statements.
Let's map out that fallout. If I'm an investor looking at this company's financials, trying to determine if their stock is undervalued, what is the actual mathematical impact of this one copy-pasted legacy paragraph?
The fallout ripples through every major financial statement. First, the company's current profits are mathematically overstated.
Overstated,
By
okay.
intentionally deferring past service cost expenses that the standard dictates they should have recognized immediately in the current period, they have artificially inflated their bottom line. They look significantly more profitable than they actually are.
Because they've hidden the expense in the theoretical future. And what happens to the balance sheet?
Their liabilities on the balance sheet are understated. They have mathematically failed to recognize the full weight of the defined benefit obligation they actually took on when they amended the plan.
So the balance sheet looks healthier, less leveraged than reality dictates.
Exactly.
And what about the institutional defense mechanisms? What is the fallout for the auditors who signed off on this?
This is where regulatory scrutiny becomes intense. If an external statutory auditor signed an unqualified audit report on these financial statements without catching this explicit policy violation, their entire audit documentation is deeply flawed.
Basically useless.
They fundamentally failed to identify a material noncompliance with the core financial reporting framework. If the regulators review those working papers, the auditors have no defense for missing an explicitly stated non-compliant policy.
And finally, circling back to our core listener, the investor. If someone bought shares in this company based on that artificially inflated profit and loss statement and that understated liability profile, they were buying an illusion.
A total illusion.
They paid a premium for earnings that were essentially borrowed from future periods. When those deferred expenses eventually hit the P&L in the coming years, dragging down future earnings, the stock price will likely correct.
And the investor absorbs the loss of that hidden error.
It's terrifying when you realize how a few outdated sentences in an accounting policy note can fundamentally distort the valuation of an entire corporation.
It really is.
It really makes me realize that if a massive lifted company can make this egregious mistake and their highly paid auditors can completely miss it, literally anyone can fall into this trap. Which begs the question, where can professionals, CFOs, external auditors, finance controllers, or even CA students go to ensure they do not become the next cautionary tale?
This is where we introduce what is arguably the ultimate safety net for financial professionals in India. The team at Gap Advisors has built an incredibly robust, deeply granular issue repository on their primary platform, gapadvisors.com.
An issue repository. That sounds vaguely helpful, but what does that actually entail in a practical sense? Because reading the raw standards is clearly not enough, as this company proved.
It is a massive, highly searchable database hosting over 4,500 distinct issues and their detailed expert responses concerning the application of both AS and Indian GAAP.
Over 4,500.
Yes. It's essentially a living encyclopedia of every real-world complex application headache a finance professional might encounter, thoroughly analyzed, solved, and documented.
4,500 highly specific application issues. That is a staggering volume of technical data.
And the architecture of the user experience is specifically designed for immediate, actionable problem solving. Any person can register on the site absolutely for free.
For free.
Yes, for free. Once inside the ecosystem, if you're stuck on a complex, nuanced accounting treatment, like our past service cost vesting dilemma, you can submit your specific issues on Ind AS and Indian GAAP directly through the platform's interface.
I see the immense value of a repository containing 4,500 historical issues. But I have to challenge the implementation here.
Okay, go ahead.
Accounting, as we've discussed today, is incredibly nuanced. The devil is always in the specific wording of the corporate contract.
That is true.
How does an auditor actually use a past issue from a database if their specific client's defined benefit plan amendment has a slightly different vesting condition or, like, a unique actuarial assumption? Do they just read a similar issue and try to guess the delta between the two? Because guessing seems like exactly how our listed company got into this mess.
You are absolutely right that approximation is dangerous in financial reporting. If the repository doesn't have an exact match for your nuanced scenario, the platform does not leave you guessing.
Oh, really?
When you submit a new specific issue on IndAS or Indian GAAP through the portal, a detailed bespoke response analyzing your exact parameters is generated and delivered directly to the inbox of the email you registered with on gapadvisors.com.
The bespoke, documented response sent directly to your inbox. That completely changes the dynamic.
It's a game changer.
I mean, I'm thinking specifically about the audit teams here. You're grinding through the final days of an audit, trying to finalize your working papers, and management presents a highly convoluted past service cost amendment that they claim is partially vested and partially unvested based on complex performance metrics.
Right.
You, as the auditor, need to document exactly how you address this issue to prove to the regulators that you strictly complied with IND AS 19.
Precisely. Auditors are operating under unprecedented regulatory scrutiny today. They require bulletproof, technically sound documentation proving exactly why they accepted or rejected a client's specific accounting treatment.
Right.
Having access to a repository of 4,500 plus resolved issues is a massive baseline. But the ability to submit your specific convoluted scenario and receive an expert documented analysis delivered straight to your inbox is an invaluable tool for immediately strengthening and defending your audit files against future regulatory reviews.
But let's take it one step further. What if reading an email, even a highly detailed one, just isn't enough?
It happens.
What if the issue is so deeply entangled in a company's unique historical compensation structures or involves conflicting actuarial reports that you cannot simply convey it in a text box? Sometimes you need to actually debate the logic in real time.
Well, JAP Advisors has engineered a solution for that exact level of complexity as well.
Well, they have.
They understand that at the highest levels of corporate finance, you often need a dialogue, not just a document. So, you can book a one-on-one direct consultation regarding your highly specific IND AS and IFRS issues directly with the author of the task and newsletter, CA Manage C. Iyer.
The author himself.
Yes. You can schedule this direct engagement through his professional page on topmate.io.
Booking a session on topmate.io. So a CFO or an audit partner can literally get screen to screen with the exact expert who's actively finding these massive structural errors in listed companies and have him untangle their specific reporting mess in real time.
Exactly.
That is an incredible escalation of resources, from a free database all the way to bespoke, face-to-face forensic consulting.
It bridges the critical gap between theoretical standard knowledge and the messy, nuanced reality of practical application. It ensures that finance teams and auditors are not relying on assumptions or outdated habits when they sign off on those financial statements.
Well, as we finally wrap up this deep dive into the incredibly muddy, highly consequential waters of employee benefits, vesting conditions, and the catastrophic impact of past service costs, I have to say, it leaves you with a lingering sense of unease.
It absolutely raises a profound and disturbing question for anyone engaged in the financial markets.
Right.
If a massive, publicly listed company and entity armed with layers of internal financial controls, specialized audit committees, and highly paid external statutory auditors, if they can completely and utterly miss a fundamental paradigm-shifting transition from AS15 to IND AS19.
If they can just blindly roll forward and copy-paste an outdated, non-compliant policy regarding millions of rupees in deferred liabilities.
Right. How many other ghosts of old, superseded accounting standards are currently secretly haunting the accounting policies of the companies you invest in?
What other legacy policies have simply been copy-pasted into the new era, silently inflating current profits, hiding long-term risks, and distorting the fundamental reality of the balance sheet? It really makes you look at a set of published financial statements with an entirely new level of skepticism and scrutiny.
That really should.
Well, thank you so much for your time today and for expertly walking us through the historical context, the mathematical realities, and the systemic importance of this complex topic.
It was my absolute pleasure. As we saw today, knowledge is only valuable when it is rigorously understood and correctly applied to reality.
We want to explicitly request all of you listening today to please follow or subscribe to the Gap Advisors Indigas Clinic podcast on Spotify, Amazon Music, or YouTube, whichever platform you personally prefer to utilize for your professional audio content.
And please do not forget to follow the Gap Advisors Indias Clinic channel on WhatsApp. It is unequivocally the fastest, most efficient way to get instant, direct updates on all new videos, podcasts, newly published newsletters, new technical issues responded to, and critical new standards issued by the regulator.
Finally, we have a direct request for you, the listener, to help us actively build and fortify this community of professional knowledge. Please share this specific deep dive among your professional contacts, your corporate colleagues, your internal audit and finance teams, and especially we urge you to share this content with students currently pursuing their CA course.
Yes, that is so important.
Helping to spread the vital, practical, unvarnished knowledge of Indian accounting standards is the only way we eventually clean up these diagnostic muddy waters for good. Thank you for your time today. Until next time, question the assumptions and keep digging into the details.